I think the banking sector is a ticking time bomb. It's massively over leveraged and massively undercapitalized. And I mean, if you look at the commercial real estate situation, Lena, it is a ticking time bomb. I mean, I think you can see that in no greater example than what we recently saw in St. Louis, where the former One AT&T Center, the third largest building in all of St. Louis, 44 stories tall, which was sold for $205 million to a real estate investment trust in 2006, just sold for $3.6 million.
According to recent reports, the US commercial real estate market is in turmoil, with shocking examples like the AT&T Center in St. Louis, once valued at $205 million, now selling for a mere $3.6 million. Andy Schectman warns that this is just the tip of the iceberg, signaling a ticking time bomb within the banking sector. Over-leveraged and undercapitalized banks are facing $1.5 trillion in leases and loans that need to be reset at higher rates within the next year. Schectman points out the risk of bank bail-ins, where depositors could be the last to get paid in a crisis, highlighting the fragile state of the FDIC with only $130 billion, backing over $18 trillion in deposits. With regional banks holding 70% of commercial loans and systemic ties through derivatives, the potential for a broader economic collapse is real. Schectman stresses that now is the riskiest time to leave your money in the bank.
Now, think about that for a moment. How do we continue to see these types of literally destruction of equity and massive hits to the balance sheets of these regional banks before we start to see a very big problem? $1.5 trillion or more in these leases and loans that need to be reset within the next year, all at higher rates, spells very big problems for a banking sector that, during the pandemic was allowed to relinquish reserve requirements down to zero. And so, yeah, I think we are nowhere near out of the woods yet for the banks. And quite frankly, you had Powell saying that we will see consolidations. That's not to be surprised. And look, I would simply say to you that we're a long way away from being safe in the banks. And when we talk about the FDIC, it has 130 billion or so in assets backing over 18 trillion in deposits. Most people, there are a lot of people who don't understand the significance of this. They don't understand that bail-ins were written into law in the Dodd-Frank Act. Most people don't even know what a bail-in is. In essence, the depositors are unsecured general creditors, i.e. the last to be paid in a banking issue. What's happened is that, the banks that have failed already, first you had Silicon and Signature that we legally bailed out by the Fed, by Janet Yellen, by the president. She said it was an uber majority vote between the FOMC, the FDIC, herself, and the president, but made it very clear that if banks fail in the future, that they won't be bailed out, they will be bailed in unless they are deemed through an uber majority vote to be too systemic. The other banks that have failed have been gobbled up by the likes of JP Morgan or other larger regional banks. So people really haven't had to think about the significance of a bank bail-in, which basically means anything above the FDIC level, which we just talked about as being fugazi, goes into the kitty to bail in the indiscretions of the bank. And I think that, just by them telling us that they're all these troubled banks, these problem banks, more indication that it will happen. And, they lay crumbs at your feet so that they can say, see, we told you. But the question really becomes, what happens if it starts to become systemic? This is why Credit Suisse had to be bailed out by UBS and why Silicon and Signature had to be bailed out, because there are banks that are systemically tied through derivatives to the industry that if they go, the daisy chain really, I think, could be something that we really don't have an idea of how fast it plays out and what does happen. But leaving more money than the FDIC BS limit covers into a bank, I think, is really naive at this point. People are moving away from the big cities as things get worse, and then things get worse because people are moving away from the big cities. There's something called the Cloward-Piven theory that people should check out. It blew my mind when I read it. It's about, it speaks to a husband and wife, Cloward and Piven. They were professors at Columbia University in the 60s. Interesting that Obama went there, as did Madeleine Albright and Bill Barr and Eric Holder and many of the people who are influential, including Jared Bernstein, this knucklehead chief financial or chief economic advisor to the Biden administration. I'm sure many people have seen that video that was going around Twitter, where he really embarrassed himself and the office of the presidency, really, as being the chief economic advisor. But this is a guy that went to school there too, and the whole thing of it is to overwhelm the system, the inner cities, through mass participation on entitlement welfare system and on blowing up the inner cities. I mean, if you look at 17 million people that have come into this country illegally, a large portion of them are in these big blue cities, which now, by the way, they're trying to give extra votes in the electoral college to these blue cities. I mean, you can't make it up, but the whole premise is to create a serfdom of people that will never vote Republican, that will, in essence, render the elections moot because they will always vote for the dole. And the premise is that you overwhelm the system, and which leads to universal basic income and on the way to socialism. Let's hope it doesn't happen. But this was taught. And if you read about the Cloward-Piven theory, you'll be like, my goodness gracious, this is what they're doing. But this is what's happening in the inner cities. People are moving away because of what you see in the inner cities. And they have no interest in going to work in these tall office buildings that have, a massive carry cost if they can work from home and feel safe. And that's what you see happening. So I think it will be concentrated in places like, New York City, San Francisco, any of the big inner cities, Philadelphia, where you're seeing a massive amount of migrant issues and people working from home. These loans, these leases are real, and people are just walking away from them. And yeah, I think because it feeds upon itself. When all of the people leave the office buildings, what happens to the restaurants and the bars and the shops around it? And they start to leave, and then it just feeds upon itself. So yeah, I think that this is really a very big problem that people should keep a close eye on. The difference between a home mortgage and a commercial real estate loan is that they're largely non-recourse if for the commercial real estate, meaning that there is no recourse. You just give them the keys and say, I'm out, and you lose whatever you had into it. But when you take a look at these buildings, the maintenance of these buildings is worth more than they're bringing in. It's as if I placed a very, very large order for a client who says, I want $10 million worth of silver, and the price of silver falls by $1, and I'm out tens of thousands of dollars because the client disappears and doesn't pay for the order. Do I hold it and wait for it to hopefully come back? What if it falls another $1 and then another $1? At what point do you realize, my goodness, this is a weight around my ankles and I'm falling into the water? What happens? So I think it's a decision that has to be made. It's not one that people really like to make, but these are real situations. What's happening to the inner cities, to me, Lena, is just horrific and very sad. When you see lawlessness in the inner cities, when you see police officers beat up in Manhattan in broad daylight, when you see this wonderful places like San Francisco turn into and Sacramento. I mean, you can't believe what you see when you walk down these streets, tents and people doing drugs right out in front of you, and you're not really going to want to walk to a ball game or to dinner or back to your car at the end of the night, or any of these things. You're not going to let your 16-year-old daughter work at a mall in the inner city, in one of these big malls, just like the big one in San Francisco. Biggest one, they just shut the doors and left. The biggest hotel in San Francisco gave back the keys because at some point it just becomes ridiculous. And I think that's where we're at right now. There'll be parts where you don't see these horrible parts of the country where you don't see this type of horrible market action. But remember, it's the regional banks that hold 70% of the commercial loans. And so it doesn't have to be in your state where this happens for it to affect you, because the systemic nature of all of these banks and how they're all tied together and through derivatives and the reinsurance and all of these things that are all tied together systemically has a far-reaching effect. But yeah, I think it's naive to think that the commercial real estate problem will not really begin to put strain on the banks, and by a broader stroke also the economy, because you're seeing these inner cities just start to shrivel up. many of them anyway, and I think it's just beginning the urban doom loop. So as the big money leaves these cities and goes to places like Texas and Florida, South Dakota, Wyoming, and moving away from the craziness, what's going to happen to everyone who's still there? If they have the ability to move, they will, and if not, it will just become worse and worse and worse. And these big high rises that have huge nuts attached to them, what happens there? I don't know. Do they turn them into public housing? I'm not really quite sure, but I will also tell you that it doesn't help the situation when you've had years worth of zero bound federal funds rate and really low interest rates and really, copious amounts of money poured into the system, where the valuations of these buildings have gotten way out of control, way out of whack. The price discovery, what is the real value as rates go higher? And to find equilibrium between rising rates and property value is going to be a very painful experience as well. So the valuations on these banks' balance sheets, most of them are fugazi. When you see a building in St. Louis that sells for $3.6 million, that was $205 million 12 years ago, Houston, we got a problem, a big problem. And that's just the tip of the iceberg. So I guess we'll see how it plays out. But if I were a betting man, yeah, you wouldn't see the Federal Reserve chief say, yeah, there's going to be a lot of bank consolidations. That's a nice way of saying it. He's telling us there's going to be more problems in the banking sector. And I think we're by no stretch of the imagination out of the woods. And then, we could also look at these fintech companies, like we see beginning to have problems, like we just saw here last week, the fintech companies where there's disputes about the amount of money that is owed between the fintech company and the banks that they're representing. So there's a lot of stuff right now where the banking sector really is a scary place to leave your money, largely because it's uninsured to a large degree. It's overvalued, it's undercapitalized and over leveraged. I think leaving your money in the bank right now is as risky as it gets.